Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the second quarter of 2023, and that stock is Tesla. And as you can see, over the last year, Tesla is up about 1%, while the rest of the market is up 14%, so they're underperforming the market over the one-year chart right now. But in this video, I'm going to look into some of the recent news that came out surrounding Tesla. I'm going to look at their financial statements so we can see their results for the second quarter, and then I'm going to use a discounted cash flow model, as well as a couple of other analysis tables to delve a little bit deeper into Tesla's underlying financial health and compare them against some of their competitors to see if they're currently a good buying opportunity in the market. So right here in this article, it's titled "Buying Anything But a Tesla Makes No Sense Right Now." They're basically comparing Tesla to a lot of the other companies that are creating electric vehicles. For starters, they point out that several car companies right now are saying their electric vehicles will be built with Tesla charging standards starting in 2025. And right now, buying a electric vehicle that is not a Tesla would mean finding charging stations will get more difficult in a few years because a lot of electric vehicles are shifting their build to adapting to the new Tesla electric charging stations that are going up all over the country. So for starters, right here, they point out that Ford, General Motors, Rivian, Volvo, Polestar, and more have said that they'll start building their electric vehicles with Tesla's North American Charging Standard, known as NACS, beginning in 2025, so their customers would have access to Tesla's Supercharger network. And obviously, Tesla has built out one of the most successful supercharger networks for EVs all across the country. And so if you're buying an electric vehicle that does not, or that isn't compatible with Tesla's supercharger network, it's going to be very difficult for you to charge your electric vehicle. Also right here, they point out that until recently, EV makers other than Tesla have used the combined charging system known as CCS. With automakers, charging providers, and more moving to Tesla's tech, CCS will be far less common in the coming years. Also, they point out that right now, a lot of people who have electric vehicles, except for Tesla owners, so these are for people who have electric vehicles that aren't Teslas, are trying to figure out how to use their vehicles because they're currently becoming more and more obsolete. Maybe they could buy an adapter so that they could use an adapter with their vehicles to charge them at Tesla charging stations, or they could somehow try to have some sort of new plug system put on their car. But ultimately, it's becoming very, very difficult for anybody to buy an electric vehicle from a company that isn't Tesla. Also right here, they point out that if you're about to spend $30, $40, $70, or $100,000, they're basically saying that if you're buying any electric vehicle except for a Tesla, they might be obsolete, and in the next 1 to 3 years, they're all going to be replaced with a new system. So there are a lot of reasons why people might not be buying electric vehicles from a lot of Tesla's competitors in the next few years. If there is an electric vehicle that's purchased, it's probably going to be a Tesla. And then right here, lastly, they point out that as electric vehicle technology gets better overall, including range improvements, faster and bidirectional charging, lower costs, and battery breakthroughs, buyers might wait or go to Tesla if they feel the company's tech is more future-proof at the moment. So a lot of reasons for why Tesla is currently way ahead of their competitors. Obviously, there's been a lot of news coming out recently that Tesla has been cutting the cost of their electric vehicles, making them an even more attractive purchase at the moment. That, coupled with the fact that they've vertically integrated their charging station and their electric vehicle experience, makes it very difficult for anybody who doesn't own a Tesla, but owns a different electric vehicle, to actually use the electric vehicle because the entire electric network is built for Teslas. So right here we have their financial statements comparing total revenues and earnings and everything else for the second quarter of 2023 to 2022. And then you can also see the rest of their results for the quarters in between here, but I'm just going to focus on the second quarter. Second quarter for 2023 revenue was $24.9 billion, up from $16.9 billion 1 year ago. So that's an increase of 47% in their revenue year over year. And then we can see bottom line net income here of $2.7 billion, up from $2.2 billion. So that's an increase of about 20% year over year in their bottom line net income. And I know it doesn't say it here, but they actually delivered 466,000 vehicles, which is up 83% year over year from 254,000 vehicles. And for their supercharger stations, they currently have 48,000, which is up 33% from 36,000 in the second quarter of 2022. So they're building out more supercharger stations and they're delivering a lot more Teslas to their customers. So that's all very good news for Tesla. Right here on page 22, Total assets for their balance sheet, $90.5 billion, up from $68.5 billion year over year. We can see that total liabilities amount to $38.4 billion, and then total equity comes out to $51 billion. So most of their business is financed by equity compared to liabilities. And then you can see that makes up the total of the $90.5 billion on their balance sheet. And lastly, for a statement of cash flows, they had $3 billion of operating cash flow in the second quarter compared to $2.3 billion in the second quarter of 2022. And we can see across their investing activities and their financing activities, they're not really repurchasing common stock or paying out dividends to their shareholders at the moment. They're keeping all of their cash in the business and just focusing on building the best possible product and reinvesting back into the company. Then right here, this is a discounted cash flow model to figure out the intrinsic value per share for Tesla. Yahoo Finance is estimating that the company is going to grow at 10% for the next 5 years. They have around $7.5 billion of free cash flow for their most recent full year, $12 million cash position after subtracting debt, and 3 billion shares outstanding, putting their intrinsic value per share at $41 per share, which means that at the current share price, they're currently not trading below estimated intrinsic value per share. Since they're currently trading at 258, you'd probably want to buy them at a bit of a cheaper cost than they're currently trading at if you were trying to buy them from a value investing perspective based on these growth rate estimates. Obviously, these might not be accurate because Tesla has been growing a lot faster than this, but these are the estimates that I found from Yahoo Finance. So for the purposes of this video, I'm just going to stick to that. But I encourage everyone to do your own due diligence and use your own metrics when you're analyzing Tesla. So right here, I did a competitor analysis comparing them to two of their other competitors, Ford and General Motors. We can see that Tesla has the highest gross profit margin, net profit margin, return on assets, and PE ratio. The company that's trading cheapest is GM. They're only trading at 6 times earnings. But in terms of profitability ratios, we can see that Tesla clearly has the upper hand. They have the pricing power and they have the profit margins to boot. But unfortunately, they don't pay a dividend, which could be actually a good thing because they're keeping all of their cash in the business, reinvesting back into the product. Right now, the highest dividend yield goes to Ford with $4.30 for every $100 that you invest into Ford. And then lastly, I wanted to compare Tesla against other companies we've looked at. Across the board, they didn't really make it onto any of the tables that we have gathered here for the total of all the videos we've been analyzing. For intrinsic value, obviously they weren't trading below intrinsic value, so they didn't make it onto the table. Google, Alibaba, GE, and Etsy are the only companies on the list that are currently trading below intrinsic value per share. For growth rate, they only had a 10% growth rate, not good enough to get them onto the table there. For profitability ratios, they had a 25% gross profit and a 15% net profit, so not good enough to get them onto those tables. And then they don't pay a dividend. We can see that for the last 3 tables, they are very competitive. Tesla shot to the top of the Q2 year-over-year revenue growth table with 47% increase in revenue growth. Second place went to Kura Sushi with 29%. And then for year-over-year earnings growth, we can see Tesla increased their earnings by 20%, coming in 4th place. First place went to Kura Sushi with 240% increase in their earnings for the second quarter year over year. And then lastly, for stock performance, clearly Tesla is far ahead of everybody else. They've returned over 1,144% over the last 5 years, and that's up from the last quarter. Obviously, I tend to analyze Tesla a lot, so last quarter, I believe they were up around 990% over the last 5 years. But since the last 3 months, they're now up 1,144%. Second place going to AMD with a little under 700%. So obviously, compared to the other companies we've looked at for stock return and for year-over-year revenue and earnings growth, Tesla is very competitive. But in terms of profitability ratios, estimated growth rate, dividend, and intrinsic value, it looks like there are some other companies we've looked at that were doing a little bit better. For competitor analysis, we can see Tesla is doing by far a lot better than a lot of their competitors in the electric vehicle market, as the article also touched on. And then for the discounted cash flow model, they're currently not trading below intrinsic value per share. So let me know in the comment section down below what you guys think of Tesla. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.